Hello, viewers. Welcome to my channel, Sensor 360 Investor. Today, we're going to continue with the wealth theme, and so that's kind of central to our 360-degree framework of our strategy book. So before we begin, quick word about the disclaimer. The channel's not providing financial advice. Please pause, read, and then continue. Thank you. Okay, so without much further ado, let's begin the show. We're going to take a look at the 60/40 portfolio. You've probably heard about the 60/40 portfolio, or you've heard about it from the financial media, or read about it, but let's take a look at this. And so let's begin by taking a look at our past history and performance. This is a 20-year chart from JP Morgan, and over this time period, 1993 to 2018, so we see that the average investor actually underperformed pretty much all the different asset classes. So a very poor performance over this 20-year cycle. Now we do have two super bear markets in that period as well. But if we then move up to 60/40 portfolio, we can see that would have done better than the average investor's return at 5.2, slightly underperforming the benchmark S&P 500 at 5.6, and the benchmark itself underperforming oil and gold and REITs. So if we look at the next decade, so here's a 10-year period from 12 to 21. Now in this period, most of the market was in a kind of a super bull market. We did have the COVID period in 21. Through this 10-year period, we see that the average investor did better at 8.7%. However, still underperformed the 60/40 portfolio by a notable margin. REITs still showed up. Small caps show up pretty good here through this bull market, but S&P 500 benchmark outperformed all asset classes over this 10-year period. So the question is the average investor better off following the 60/40 portfolio? Because we've seen that over 3 decades. If they had been less active and just followed the 60/40 portfolio, they actually would have done much better. So let's have a look at the 60/40 portfolio, what it is. So 60% of your assets are allocated to equities, 40% to bonds. And within bonds, you can allocate out to treasuries, municipals, corporate, and within stocks, you can construct a portfolio. If you're aggressive, do it yourself, you can handle 8 stocks, kind of solidify and focus and concentrate. If you're moderate, you can try for a portfolio of 12 stocks, and if you're conservative, 16. There's a modified version of the 60/40, which is the 60/30/10. Basically, you still stay with 60% allocation to equities. You reduce your bonds by 10% to 30, and then you move that 10% to other. Then the other category, you can consider putting dry powder, or precious metals, or investing in commodities. So that's a modification on the 60/40. So back to JP Morgan. So this is a chart that shows from 1950 to present being 2023. So it's a fairly recent chart. It's a bit hard to read because the colors they've chosen don't lend themselves too well to this exercise. But the green is the returns from the equity portfolios. Fixed income return is the gray, so that's fairly well easy to see. But the diamond, which is hidden, is the 60/40. So you have to kind of look for that diamond. So, like for example, here, which was in 1974, which is obviously we had the oil embargo, the bear markets over here. In this market, everything underperformed. Equities were down, fixed income underperformed equities, and the 60/40 underperformed both of those. And then we go over to kind of the late 60s, similar action here. Equities underperformed by 10%, and then fixed income underperformed even the equities, and 60/40 underperformed both those asset classes. But if we go over to another time period here, which is going to be another probably recession year, here fixed income outperformed equities, positive return, and the 60/40 outperformed equities as well. On the flip side, like if we go to, so this is 1950, so this is about 51, 52, 53, 54. 1954, we can see equities had a good year. Fixed income still outperformed, and the 60-40% portfolio did even better than that. So you can study this chart, and what you'll find is that most years the 60-40 does pretty good. And year to date, we can see equities are up, fixed income is doing marginally better. And according to, at the point this was printed, the 64-40 portfolio was doing pretty good as well. Okay, now instead of to even simplify the equity side and the bond side, the simplest implementation of a 60-40 portfolio is using these two ETFs from Vanguard. You can use their equivalent mutual funds as well. But given that ETFs are very easy to trade these days, and the expense ratios are so low, you know, first consideration should be to these two. So 60% of your allocation would go to VTI, which is the Vanguard Total Stock Market Index. So this is a large basket of stocks from all over the world. And then 40% would go to Vanguard Total Bond Market. And it's as simple as that. So you would basically put 60% to there, 40% to there, hold for 1 year, and then rebalance your portfolio. Okay, so since we've started to track Dogs of the Dow, and now the 60-40% portfolio, and there will be additional strategies I'm going to start introducing here as well. So basically, the S&P, as of Friday's prices, the S&P 500 benchmark is at 8.21%. Dogs of the Dow are slightly down at 0.56, and the 60-40% portfolio itself is not too shabby at 5.22%. And so this is as of Friday's close, and there'll be more strategies added here. I want to see how different strategies perform, and so we'll do that under the tradable strategies, which will be a new video series that will start to appear in this channel stream. Okay, so that's a quick introduction to the 60-40 portfolio. There are variations to this, like depending on your age. If you're younger, you can vary the dial to increase your equity exposure. If you're older, then you would go the other way, dial up your bond exposure. All depends on the age, your time horizon to be in the markets, and your risk profile of how conservative or aggressive you are. So we'll cover, as we get more into the updates and tracking these and other strategies, we'll touch more upon that. So that's it for now. If you're not a subscriber, please do subscribe, and thank you in advance for that. If you are, thank you. And that's it for this video. I will see you next video. Goodbye.